Are you someone who loves shopping for a bargain? In an environment where the equity market has seen some incredible outperformance, investors wonder where they might look to find good quality stocks on sale. There are definitely pockets of opportunity out there in stock land for most investors, and we'll tell you where to look right now on UBS Trending. Hello, everybody, and welcome to UBS Trending. I'm your host, Anthony Pastore. My friend and colleague from ProShares, Simeon Hyman, is joining me here in the studio today to break down opportunities in the equity space. Simeon, first of all, good to see you. Thanks for coming in.
Thanks for having me.
Of course. Love to have you here. It's been a while since we've had a chance to sit here and have a conversation about the markets. But it's interesting because certainly we've seen a lot of strong market performance. We know, of course, that the seven top tech, most of them tech names in the S&P have really been the tide that lifted all boats. But outside of that, investors are looking for those pockets of opportunity. So when they're thinking about investing today through the rest of the year into next year early, say, first 6 months, where do you find that those opportunities exist? Where do you see that all-weather performance?
The challenge is everybody knows this Magnificent Seven thing, a top-heavy market. So we know there's some stuff that's expensive. But shopping in the bargain bin isn't necessarily the right answer. Because if you buy cheap stocks, they're going to be cheap for a reason. And even if they're not in distress, they're probably not growing. And if you buy a stock that's not growing, guess what? You kind of bought a bond. And that defeats the whole purpose, particularly with interest rates still kind of elevated. So where we think the opportunities are opportunities for quality companies that are still growing. And of course, for us, we find that with companies that have consistently grown their dividends, and they are on sale.
Right. And that's interesting because, we here at UBS, through our CIO, we have a message in focus where we're saying to look for equity laggards. And the messaging is really similar, where we're looking for quality equity, not just the bargain basement versions, but again, looking for those dividends. So where should investors be looking? Like, what kind of market cap, what kind of companies are we talking about here?
The flagship index in this space is the S&P 500 Dividend Aristocrats. It's the companies of the S&P 500 that have grown their dividends for at least 25 straight years. Now, they've been left behind, so they're trading at a discount, and yet they're showing up with high quality. If you've grown your dividend for 25 straight years, you got stuff like pricing power, you got stuff like strong balance sheets. But I'll give you a very topical data point. People have heard about this notion of earnings recession. The S&P has shrunk earnings 3 quarters in a row, but these S&P 500 Dividend Aristocrats have grown earnings in those 3 quarters. So showing up with positive earnings growth in an earnings recession, that's a marker of quality, very important.
Yeah, and the 2-year returns on that have kind of out the Aristocrats index versus standard S&P. It's outperformed there.
That's right, because it's a smoother ride.
Right.
So even though you're left behind a little bit this year because of the Magnificent Seven, the outperformance in the challenging year of 2022 is enough to put you ahead over that time period. Very important.
So it's really all about looking for quality income within the equity space. So that's really where you're guiding us here today. And same with our CIO message. That's exactly what we think is the right place right now.
Absolutely. And the story doesn't stop just with the S&P 500 Dividend Aristocrats. The methodology applies equally as well in the often forgotten mid-cap space.
That's right.
The S&P 400 Dividend Aristocrats. And if you think that if you're looking for something on sale, mid-caps are trading at 50 cents on the dollar. They've underperformed for over a decade. So applying that same dividend growth methodology to mid-caps can be a great way to access that discount in the mid-cap space.
Right. And something else, Simeon, that I know we were just talking about recently is we're looking at, equal-weighted indexes versus cap-weighted indexes. And for those who are tuning in right now, an equal weight is when they're actually priced versus on the actual equal weighting of each stock that's in the index itself, while the cap weighting looks more at the market cap. So those that have a higher market cap are invested more heavily. So right now here in CIO, we prefer equal-weighted indexes over cap-weighted indexes. What are your thoughts on that?
You're not alone on this.
Yeah.
We talked about the top-heavy market. So when 7 stocks and a handful of stocks run the market, the concentration gets exacerbated. And so an opportunity to invest in a portfolio where all the names are equally weighted is particularly important in this environment. But just saying equal weight from our perspective isn't enough, because you also need that quality screen. And the nice part about these two indices that we just referenced, the 500 aristocrats and the 400 aristocrats, they're equally weighted. And the combination of equal weight and quality is very powerful. And I'll point out one other surprising place where this works really, really well, and that's in the technology sector.
That's surprising to hear that, considering the run we've seen.
Precisely. Yeah. So if there's any place where you're worried about top heaviness, it's in the tech sector itself.
That's right.
It's trading at 35 times on a price to earnings basis. The same dividend growth screen works in technology. It's the S&P Technology Dividend Aristocrats. Here it's equally weighted, so it resolves the top heaviness, brings the valuation way down from 35 times to 22 times PE. And here's the icing on the cake. When a company raises its dividend, it's a forward-looking indicator. Everybody talks about buybacks in technology. But when a company does a buyback, it's telling you the good times were yesterday. I got a lot of money last year, let me buy back some stock. But no company ever wants to cut a dividend. So when you increase your dividend, you're telling the market that you're confident going forward. It's a very cool application, particularly in the tech sector. So I want folks to understand the application of dividend growth to technology as well.
Yeah, it's fascinating to think of it that way. I mean, we hear about buybacks all the time, but to think that what you look as like a backwards or forwards looking versus a dividend increase, big difference there for what a company is telling its investors.
Absolutely.
Yeah. What about on the value side, value stocks? So opportunities there?
Back to the beginning of our conversation, the challenge with value is, where is the growth? The temptation with higher interest rates is to say, I want lower duration, which is a jargony term. It just means I want more of my money sooner rather than later. Because if interest rates are high, money that's coming to me 20 years from now is worth even less. And so people say, I want a value stock because it's so cheap that more of its earnings are coming at me this year and next year and the year after. The problem is back to the question of growth. Too many of those deep value stocks aren't growing. And if they're not growing, it's like a fixed coupon bond, and that's the most exposed thing you can get in an elevated interest rate environment. And they have underperformed in most of the world, except for Japan, which had done really well with value. But everywhere else, it seems that there's been some underperformance and it's
there.
Precisely the same with high dividend yielding stocks. In this dividend landscape, there are two piles of companies: dividend growers, which we've talked about for the last several minutes, and then some people will gravitate to the dividend stocks with the highest dividend yield. But those are the ones that aren't growing, and they're particularly exposed with lingering 3% and 4% inflation and a 5.5% Fed funds rate that might plateau for a little while.
That's exactly right. Yeah, we could get into that's a whole other conversation, right? Simeon, thank you very much. Always good to have you here. Simeon Hyman from ProShares. Good to see you, my friend. And for more information on anything that's coming out of ProShares and other great partners like them, plus our CIO, please check out our website at ubs.com/views and follow UBS on social media, all the platforms. Plus, check out our dedicated Instagram channel at UBS Trending for all of the studio's content that you're not going to find anywhere else on the net. And as always, if you have any questions about your portfolio or anything that Simeon and I spoke about today, make sure you are speaking with your financial advisor. Until next time, I'm Anthony Pastore. We hope you have a great rest of your day, everyone. And remember to keep your eyes on what's trending. We'll see you soon.